right, welcome to Ask Anthem, the podcast where we break down complex tax topics for real estate investors and business owners. I'm your host, Sarah. I'm the digital marketing specialist at Anthem, and today we're diving into a hot topic, the tax implications of flipping versus holding rental properties. So joining me today is our very own tax expert, Mayra. Welcome, Mayra.
Thank you. Thank you for having me.
Of course. So just starting off with the basics, can you explain the main differences between flipping a property and then holding it as a rental, especially from a tax perspective?
Yeah, so flipping a property, also known as dealers, which is what the IRS would refer to them as, is a short-term investment where typically properties are held for less than a year and income comes from when they sell the property, and it comes from renovating, and it taxed at ordinary income tax rates. A rental is more passive income, whereas long-term investment properties are held for years or even decades, and income is generated through ongoing rents and sometimes appreciating property.
Gotcha. Okay, so let's dig into flipping first. What are some key tax consequences for people that flip houses?
So most house flippers are classified as dealers, not investors. They buy, renovate, and sell properties as a business. So that means their profits are treated as ordinary, not capital gains, and they could be subject to self-employment tax as well, depending on their structure. They cannot take advantage of 1031 exchanges, depreciation, or installment sales that rental properties would probably be eligible for. In addition, like I said, the self-employment tax is like 15.3%, and that's in addition to a federal rate and a state rate, depending on where you live.
Okay, so if I flip a house and I make $50,000 in profit, how much might I owe in taxes?
It depends on your tax situation because everyone's different because you have other income in there. But let's say your full income is $50,000 and your federal tax rate would probably be around 22% bracket for the federal. From there, you would take 50,000 times the 22% tax bracket, and it would be around 11,000. And then you have to take into account the self-employment tax, which is 15.3%. If you take 50 times 15.3%, that's 7,650. So you would take the federal tax, which was 11,000, plus the 7,650. Roughly, that's $18,650 of just federal taxes. That is not including the state income tax rate that you would be paying on that. It really depends where you live, but roughly that's how much you would pay in tax.
Wow, okay, so are there any deductions that I could take if I was a flipper?
Yeah, they're pretty limited. You could take the materials you spent, the labor, utilities, insurance, the interest, which would probably be your biggest expense. And usually when you're working on a house, you cannot deduct it on the year you're working on it. You move it up to what we call capitalizing it and adding it to the basis of the property. So when you sell it, the cost basis is reduced and it offsets the capital gain that you would incur when you sell the property.
Okay, interesting. I see. So let's switch gears really quick to holding rental properties. How does the tax treatment differ there in that space?
So rental income, as it's considered passive income, it is taxed as an ordinary income as well, but it offers way more deductions where you can deduct mortgage interest, repairs, depreciation, which would probably at the beginning when you buy the rental property, that would be your big expense, depreciation. And I can go into detail further on. You don't have self-employment tax either. So that you get rid of the 15.3% that the flippers would be dealing with when they sell the property, and rental income is held more long-term. So if you sell it down the road, you get treatment of long-term capital gains, whereas the flippers would have the short-term capital gains.
Gotcha. So you mentioned depreciation. Can you just give a quick example of how that works?
Yeah, so let's say you buy a rental property for $300,000. And the land is valued at $50,000. You can't depreciate land, so we have to take land away from that cost. So what you would do is take the purchase price of $300,000. Land is $50,000, so you get building bases of $250,000. Now for residential, your depreciable life is 27 and a half years. Commercial is 39-year life. For this sake, it'll be 27 and a half years. So you take the $250,000 of building bases, and you divide that by 27 and a half years, and that will give you roughly about $9,090 of depreciation that you can take every single year up to 27 and a half years for when you hold that property. So that's depreciation. That's how you would calculate it in this case.
Gotcha. Okay. Thanks for breaking that part down. And then what about when you sell a rental property?
When you sell a rental property, it's different from when you sell a primary residence, where selling the rental property involves having capital gains tax, and depreciation recapture. So the capital gains tax will be if you bought the rental property at $300,000, you sell it for $500,000. You will pay capital gains on the difference of what you sold it for. But then the main one would be depreciation recapture, which that one is you have to pay tax on the depreciation that you took. Say you took depreciation of $25,000 for a property and you bought it for $150,000. So your adjusted basis is $125,000. The capital gain, if you sold a property for $200,000, say, it will be $200,000 less the adjusted basis of $125,000, $75,000. Depreciation recapture will be $25,000 times that 25% of depreciation recapture, and that's the maximum rate the IRS says for depreciation recapture when you sell a property. It will be $6,250. The remaining capital gain, which you will take the $75,000, which I got sales price less the adjusted basis, less the $25,000 of depreciation recapture. $75,000 less $25,000 of the depreciation that we just took. $50,000 tax at your long-term capital gains, which would be, it varies on your income tax bracket, but it's 0, 15, or 20%. So let's say it's 15%, for example. You would get $7,500 roughly. So the total tax owed in this scenario that I did would be $6,250 of the recapture of the depreciation, plus the capital gain would be $7,500, so about $13,750 and some change.
Gotcha. Okay. And you also mentioned that the IRS classifies people as dealers or investors. How does that affect taxes?
Well, as mentioned previously, the dealers, they have less ability of planning strategies. They cannot defer the income. They're more of active income, so they don't get the treatment of rental of the long-term capital gains that rental properties or investors would take. Deductions are very limited as well, so their profits are way higher. They also have to pay the self-employment tax depending on their structure. Investors, they buy and hold the real estate for long-term, and they have rental income. So they wouldn't be paying self-employment tax, and they have more ability to use more deductions and defer income if they were to sell a property down the road.
Okay, gotcha. And then what factors does the IRS consider?
For flippers, it would be, well, really for both of them, is the intent. How long do they want to hold the properties? The frequency of their transactions, really overall their business activities, and it's on a property by property basis. So I could go out there and buy a real estate property and hold it for a long term. That would be considered me investing in it. I would be considered an investor. Now, if I buy a home and I decide to renovate it and sell it within less than a year, I would be considered a dealer.
Okay, that makes sense. And then what are some common mistakes that you see real estate investors make?
It varies, but mainly is like lack of research. They don't really analyze the market and how the property's condition is. Over leveraging, so they use too much debt to buy the property, and their debt to income ratio is way too high that then eventually they're not able to make payments on their debt. They let their feelings get too attached. So instead of analyzing the entire transaction, they go based on gut feeling, which can not always be right. And they end up overpaying as well, too, which bidding above market value. So that's where going back to lack of research. And then underestimating costs. So if they go see a property, they really like it, but they think, oh, it's probably going to take very little to repair, and they end up having to repair a lot. So that's some items that people make when they go into real estate investing.
For sure. Seems like a big decision. A lot of thought needs to go into it beforehand. And
yeah.
Do you have any tips to help these investors minimize their tax burden?
Seek a tax professional. It really depends on their tax structure and their own personal tax return, because everyone, as mentioned, has a different type of income. But maximizing all the deductions, leveraging a lot on depreciation, that's the biggest one for investors. 1031 exchanges, which would defer the tax gain once they sell the property. And to explain a little bit of 1031 exchanges is you sell a property, you have a gain. Instead of having to pay capital gains on that tax, you can go and buy another rental and you just put that gain and defer it into that property. That's what we mean by 1031 exchange and deferring the gain. We don't get rid of the gain. We just defer it or we minimize it.
Gotcha. Okay. So now I want to ask you some specific scenarios just to see how you would handle the situation. So the first one is, can I flip a property and avoid taxes by rolling the profit into another property?
No. So if it's flipping, which is considered a dealer, you cannot do that unless if it was a real estate property, which would go back to the 1031 exchange that I briefly explained before. But for flippers, once you sell the property, you must pay the tax regardless of however you use those proceeds. The IRS wants the money because you're being considered as a dealer.
Okay, gotcha. And then the second one is, if I live in a property for 2 years, can I avoid capital gains tax?
You can. So you can live in the property 2 out of the last 5 years. They don't have to be consecutive as long as it's 2. And you can avoid paying the capital gains tax, which for single is $250,000, and for married filing joints, $500,000. So if you sell the property and your gain is higher than those two amounts, depending on what your filing status is, you can avoid paying gains on the 250 or the 500, and anything above that, you will have to pay tax.
Okay, I see. So perfect. That wraps up our episode today. Mayra, thank you so much for sharing your expertise on rental properties. And making this complex topic a lot more broken down and simple to understand. If you're out there currently owning a rental property, thinking about it, we're always here to help guide you. Check us out online at anthemstrategist.com for more guidance. Mayra, thank you so much for being here again today and hope you all have a great rest of your day.
Thank you.